Good morning and welcome to the DuckerFrontier webinar, APAC in 2021, Preparing for an Uncertain Future. I'm Raveen Krishan, Client Relationship Manager for Asia Pacific at DuckerFrontier. Before we get started, we realize that some of you may be new to DuckerFrontier, so we'd like to take a minute to provide you with a very quick overview of our firm and how we work with executives at major multinationals. DuckerFrontier is a leading market intelligence and consulting firm that provides tailored solutions to drive growth for clients across the consumer, B2B, healthcare, and technology sectors. Our dedicated teams serve as advisors to clients, delivering the market and industry knowledge they need to succeed at all points in the business cycle. With continuous research and insights, custom solutions, and transaction support services, we provide our clients a small sample of which you can see here, with timely, actionable insights to adapt and win in changing markets. Our company is headquartered in Washington, D.C., with offices in Troy, Michigan, New York, London, Paris, Berlin, Singapore, Shanghai, and Bangalore. As part of our offering, we're excited to announce that we have recently launched a new mobile app. FrontierView Mobile, which is available for both iOS and Android, includes all the relevant content you need to monitor markets, inform strategic planning, and power key decisions in your critical markets. Having briefly introduced our company and also mentioned to you about our new mobile app, I'd like to take a moment to briefly introduce our presenter today. On the line for today's webinar, we have our Head of Research for Asia Pacific, Adam Jarzik. As the leader of DuckerFrontier's APAC research team, Adam Jarzik supports senior executives on key initiatives, including strategic planning, resource allocation, and risk management, among others. Because he's in constant contact with our clients, he will be discussing not only the results of our research, but also what we've been hearing from multinationals who are being impacted by the coronavirus. If there are any insights you see today as part of this discussion or any questions we don't get to answer, our client services team, Sarah, Althea, Yuchen, and I will be happy to follow up with you directly. And with that, I'd like to turn things over now to Adam to take us through our agenda.
Thanks, Raveen. Our webinar today will consist of a 50-minute presentation followed by Q&A. To be specific, I'll begin the session with a discussion on the shape of second wave outbreaks in Asia. During that portion of the presentation, we'll outline why we'll be dealing with the virus for the foreseeable future, how different countries are likely to respond to secondary outbreaks, and what their actions will mean for economic growth and business travel. With that foundation in place, we'll then discuss how these factors are likely to impact ways of working in the region, as well as supply chain dynamics. And finally, we'll round out the webinar with a Q&A session. So if you have any questions or points of clarification regarding any of the topics we covered today, please don't hesitate to send them to DuckerFrontier webinars via the GoToMeeting messenger by clicking on the Q&A box on the right-hand side of your screen. We'll do our best to ensure that they're addressed in the Q&A period. So without further ado, let's get started with a discussion on the shape of second wave outbreaks in Asia. I'd like to begin this section by clearly laying out the assumptions underpinning our view. We'll dig into these in more detail over the coming slides, but I wanted to bring them together into a comprehensive picture up front. So here are our assumptions. There are going to be multiple strains as the virus mutates. There already are multiple strains, but there are going to be more. But with that being said, we're going to assume that COVID-19 will not become dramatically less virulent or disappear on its own, and similarly will not become dramatically more virulent. We also are assuming there won't be large-scale reinfections of people who've already had an earlier strain, and we're going to assume here that the virus is not going to be affected by weather to a meaningful extent. So not so much a rehashing of the Spanish flu. We're also assuming that a vaccine will not be produced and distributed on a mass scale before late 2021. And then when it actually is produced, we expect distribution to developed markets first, with mass global distribution in 2022 at the earliest. We also don't see there being secondary outbreaks across multiple markets that reopen we do believe there will be secondary outbreaks across multiple markets that reopen, but we do not expect these outbreaks to be simultaneous, major secondary outbreaks that close down parts of Europe, Asia, the US, and Latin America all at the same time. In other words, when we look to the future, we don't expect to see a repeat of March 2020. And finally, we expect social distancing measures, or SDMs, to be in place even as some level of treatment becomes available closer to the end of this year at the earliest. Okay, having laid out our assumptions, let me explain how we came to them. So to do that, I'd like to start with the end in mind. There are basically only three ways in which the COVID-19 epidemic can end: mutation, vaccine, and herd immunity. When it comes to mutation, the way that would end is COVID-19 mutating to become less virulent, that is, less contagious and or less deadly. This could happen at any time, but it's completely impossible to predict. We can't really count on mutation leading to a specific set of changes because there's no telling where it'll go or when it'll get there. Things could get better, they could also get worse, which is why our base case does not include any specific assumptions about virus mutations. So if we can't count on the virus mutating in a specific way, that basically leaves us with two options: vaccine and herd immunity. We'll start with herd immunity. That's a situation where the virus spreads enough that enough the population has it and has survived that there aren't a lot of opportunities for it to continue spreading. That will happen eventually. It's just really a question of when. Unfortunately, it's probably not going to happen anytime soon, 2022 at the earliest. And so the entire point of a vaccine is to shorten that timeline. If a vaccine is discovered, mass-produced, and distributed to large portions of the population, it can get us to herd immunity more quickly. But it's going to take a while to get there, and it's not clear whether we'll ever get there. Now, some of you may be wondering about the timeline that we've laid out here for the vaccine, particularly given recent headlines, very positive headlines that have been coming out recently. So I'd like to briefly explain why we believe that the timing of treatment and vaccine could start to play a role only in 2021, definitely not this year. If you look at the slide in front of you, you should see the normal process and progress for vaccine discovery and distribution. Right, so you start out, you look at a whole bunch of different potential options. That's vaccine discovery. You go through preclinical tests to determine whether any are viable to even begin clinical trials. Once you've identified those, you go through a few phases of clinical trials. Then you have to get your vaccine approved, and then you have to manufacture it on a mass scale and distribute it. Normally, this process takes a very long time. You can see that in the orange boxes. It takes years. You'll see, if you look at the green boxes, that we made a lot of progress on this front. That's what we were comparing there is the normal process to the process we've gone through thus far with the coronavirus vaccine. Clearly, we're already operating on a remarkably accelerated timeline. But here's the thing. We still have a long way to go. And that's why we believe that a vaccine will not be produced and distributed on a mass scale before late next year. It's also why we believe that social distancing measures will need to continue for the foreseeable future, or at least until some level of treatment becomes available. Okay, so where does that leave us? Let's talk it through. To do so, I'm going to draw upon a framework developed by Tomas Puello and enhanced by our LATAM team. When a virus takes hold and cases really begin to take off, governments have to take aggressive action to bring it under control. If they implement those measures successfully and keep borders closed, basically creating a closed system, they can bring the epidemic under control. But as soon as they loosen lockdown measures or even open borders back up, they face the risk of new waves of infection. And if they choose not to intervene again, that wave will build until herd immunity is achieved. This is the strategy that several countries in Asia Pacific and around the world are taking. But naturally, not everyone is satisfied with this approach. Some governments try to contain secondary outbreaks with targeted measures. Their goal is to prevent the virus from reestablishing itself without doing undue damage to their economies. This approach requires a series of openings and closings designed to keep the virus under control. This is called the dance. Now, it's important to note that some countries are in a better position to dance than others. Those that are more nimble and can use more targeted measures are more likely to manage this process successfully. Some might say they're better dancers. Our Latin America team, which apparently enjoys dancing, likes to say that those countries that can move quickly can dance samba, while those that are less nimble can only dance bachata. Ideally, all countries would be able to dance samba, but unfortunately, that's not the case, which begs the question, what makes a country a good dancer? There are basically 4 dancing skills that are required to limit virus spread. They are early reaction, good information, healthcare infrastructure and resources, and endorsement from local authorities. Let me go through those items one at a time. So early reaction and dancing with the right tempo is basically about being able to shut down your borders early to stop importation of cases and being able to put in place social distancing measures quickly to stop domestic contagion. Countries that are able to do that quickly can keep case counts under control and can reopen the economy at the right pace. Countries that can't very often end up with large spikes in the number of cases and end up being put in a position where they close the economy too slowly and then reopen the economy too quickly. The second dancing skill, good information, is all linked to testing and tracing. You need to be able to identify and isolate cases, identify and isolate suspected cases who are contacts of those individuals, and get a handle on what the virus load or viral load in the population looks like. If you have that information, you can use really targeted measures during containment and relaxation phases. If you don't, it's really hard to make good policy, so you can end up with indiscriminate and wide-scale restrictions, which do a lot of damage to the economy. The third dancing skill, healthcare infrastructure and resources, pretty straightforward. You want to have PPE for your healthcare workers, and you want to have a strong healthcare infrastructure in place. If you have that, you're probably going to end up with lower contagion and morbidity rates. If you don't, it's really hard to keep those rates down. And finally, last key dancing skill is endorsement from local authorities. What does this mean? It means alignment internally, right? If you have alignment across top, middle, and lower levels of government, chances are you're going to see increased adherence to social distancing measure guidelines, and the population is going to believe what is said because they're hearing it consistently. If everybody's saying different stuff at different levels of government, then you're probably not going to have great adherence to social distancing measure guidelines, and people are not going to be, they're not going to have a high degree of trust in what they're hearing from their officials. Now, obviously, if we look across the region here in Asia Pacific, countries exhibit substantial variations in their ability to dance. What we've done is we've laid out the 4 dancing skills on the left-hand side, and we've rated countries across Asia Pacific on their dancing in those areas. And then we've basically pulled all of that together into an overarching rating, which is listed at the bottom under the overarching title, Dancing Skills. If we look at that bottom row, we see that some countries, different countries are, are in very different positions. Some countries are basically standing on the sidelines, the likes of India and Pakistan. They're not interested in even engaging in the dance. They're just kind of letting it go. I mean, don't get me wrong, they have made some moves, but it's pretty clear that they're taking a step back. Some countries are on the dance floor. But they don't necessarily have all the skills required to be great dancers. They've done a pretty reasonable job. It's not that they aren't in the game, they are. But there are definitely some challenges there that need to be taken into consideration. And then some countries have excellent dancing skills. And even if they've stumbled a bit, Singapore would be a good example here, they can still manage to dance well. They can still manage the samba. These variations in countries' dancing skills, as well as variations in their case curves, are why we do not expect a major simultaneous secondary outbreak that closes down all of Asia, as well as Europe, the US, and LATAM at the same time. Okay, you may be saying to yourself, this framework is all well and good, but what does it actually mean? Well, these findings have implications that range from economics to business strategy. First off, countries that can't dance are going to struggle to bounce back quickly from their COVID outbreaks. If you look at the chart on the screen, you'll see 2020 GDP growth by quarter, overarching economic growth by quarter. You'll note that the likes of India, Pakistan, Indonesia, and the Philippines are all on the lower end of these set of lines. There are some in there that we're dealing with some other stuff coming into this year. So it kind of muddles the picture a little bit. But if you look at India, Indonesia, Pakistan, and the Philippines, they're all going to experience extended contractions in growth this year. And critically, risks to their economies tilt towards the downside. In other words, it's much more likely that those growth rates are going to come down than go up. And one of the other reasons the dancing skills are so important is that countries that can dance well, that can dance samba in our terminology, are much more likely to open green lanes with each other. So what we've done on this map is basically colored countries that have better quote unquote dancing skills, green, and those that don't have dancing skills are sitting it out, red or maroon, I guess in this case, with orange countries somewhere in between. You'll note that the green countries are where we're already seeing green lanes open, or fast track lanes open. China and South Korea have established a fast track immigration arrangement. Singapore and China have opened a fast lane. Australia and New Zealand are in talks to establish a travel bubble. Business travel is probably going to be relegated to these countries, a select group of countries in Asia. That's where executives are most likely to actually be able to move reasonably freely. And of course, it's not exactly clear when these green channels will be open. So we actually wanted to take this opportunity to ask your opinion, to see what you think about timing. So if you could share with us your view, when do you think travel across green channel countries in Asia will become commonplace? Very good. So in this case, it looks like we have a range of answers, which is good. It's a nice probability distribution. Good to see that different people have slightly different views, but by and large, the answers center around Q1 of next year. That's when most people think that green channel countries or travel across green channel countries will become commonplace. Basically, what that means is that we're going to be dealing with restrictions. Well, I guess I put it this way: based on these results, as well as our earlier analysis, it's pretty clear that we're going to be dealing with restrictions on business travel for a while yet, which basically means that looking to the rest of this year, in 2021, companies are not going to be able to operate as they did in 2019. They're going to be able to travel, but only to a limited set of countries. And there is still some uncertainty associated even when that travel will be allowed to happen and how smooth it will be. So coming back to the presentation, we'd like to spend some time talking about the practicalities of doing business in this environment. Specifically, we'd like to discuss digital engagement and the staying power of digital engagement. So to lay the groundwork for that conversation, I'd like to go ahead and acknowledge up front that the companies have seen substantial cost savings as a result of COVID-driven work from home initiatives. If you think back to late last year, if you had been asked whether everybody could be working from home across so many markets around the world, or many people could be working from home across so many markets around the world, and companies could be operating with substantially reduced travel, and yet still continue to operate successfully, it would have been pretty difficult to give a positive answer. But COVID has pushed companies to try things that once seemed impossible, right? And now that it's clear that these things are possible, CFOs are licking their lips. Some companies really want to make sure that they preserve those cost savings. I've laid out some specific areas where we definitely have seen cost savings, right? In terms of reduced executive business travel, which has led to lower T&E and arguably greater ROI on executives' time. Discussions around downsized offices, which means lower rents. Fantastic way to cut down on your fixed costs. Heightened use of digital tools for sales. Hey, if salespeople don't have to travel, they can fit more meetings into a single day. More capacity for commercial meetings means more revenue upside for the amount of time that those salespeople, or you're paying those salespeople. And finally, extended work days. People don't have to commute to work. Chances are they can spend that time at work, which means more hours worked. Within these areas of focus, there are two that tend to elicit the most conversations from our executives, or at least that currently elicit the most conversation from our executives, which are reduced executive business travel and heightened use of digital tools for sales. There are serious questions about the degree to which business travel will return after the pandemic is over. Having successfully operated for months now, without all of this travel, many companies are going to ask themselves, to what degree do we actually need it? So once again, we actually wanted to ask your view on this. We wanted to ask specifically, if green lanes expand to include major APAC markets, roughly how much will business travel resume relative to 2019 levels? So envision a situation, say next year, say in Q1 of next year, where, as you noted, or it's the majority of the people in the poll noted, travel is likely to become more commonplace. How much travel is actually going to happen relative to last year? We'll wait for a little bit. There we go. All right. So the answer is given 50%. Although actually, this skews towards the downside, towards 30%. So it'd perhaps be safe to say that the individuals in this group foresee business travel coming in somewhere probably between, say, 40 and 50%, maybe 45%. This is interesting. We actually asked executives that we hosted a recent virtual executive roundtable this exact same question, and their answers were pretty close to what you all just laid out. It would seem that a large number of people would expect business travel to be cut in half relative to 2019 levels next year. In other words, as it recovers, it's going to recover a lot less than I think many executives would hope. Coming back to the presentation, it's clear, based on these results, that many executives are going to have to justify business travel like they never have had to before, particularly with budgets under substantial scrutiny. They're going to have to look across your priority list and determine where it's worth making the case. After all, not all types of commercial activity are created equal. So basically, executives are going to have to weigh the costs and the benefits of conducting certain activities via digital tools. Now, in some cases, it's pretty clear where you're going to make the case and where you're not going to make the case, right? When it comes to refilling orders, maintaining existing relationships, even prospecting, there's a clear case there for digital. When it comes to managing or conducting complex negotiations, event marketing, selling to frontier markets that have no digital infrastructure. If you want to go buy a company, do some due diligence, okay, there's a clear case against digital in all those cases. But there are also a lot of cases where it's not so clear cut, where it's difficult to say, right? Which are listed here in the middle, in the gray area. This gray area is where many challenging conversations are going to take place over the course of the rest of this year and next year. And take a moment to look at that list, right? Acquiring new customers, gathering information, launching new products, breaking into new segments. In the past, you might have been able to travel for all of these reasons. But if you now face a situation where you can't travel for half of these reasons, which ones are you going to choose? I don't want to pretend that this decision will look the same across industries, across companies, and in particular, I don't want to pretend that this decision will look the same across geographies. It won't. I want to dial in on that last point, across geographies. Travel restrictions and digital engagement are going to vary substantially across markets over the next 12 to 18 months. And this will have substantial implications for portfolio management. I want to dig into that a little bit here, because this is one area where we will see consistent results across companies. So what we've done on this slide is we've compared countries in terms of the likelihood of being included in travel bubbles, right? Having green lanes open with them, with our Global Digital Sophistication Index, which basically measures the degree to which a country is open and prepared for digital sales and digital marketing. You can see that countries range to some degree across this group. For countries, but they can basically be broken out into three buckets. For countries in the upper right-hand portion of the chart, executives will likely have a variety of options for commercial engagement via digital means as well as in person. For countries in the middle portion of the chart, executives will likely have options for digital and in-person engagement, but both will be somewhat limited. So it will be critical to determine how to strike the right balance. Perhaps most importantly, for countries in the lower left portion of the chart, the executives will likely have limited options for commercial engagement. In other words, if the countries in the lower left portion of this chart are important players in your portfolio, then you'll want to think very carefully about your commercial engagement strategy, because you're going to be limited both in your ability to travel and in your ability to engage via digital means. Will you be able to serve these markets as you have in the past? If not, how will you serve them? All right, we spent quite a bit of time speaking about how closed borders impact the movement of people. But of course, they also impact the movement of goods. So we'd like to spend some time talking about upcoming shifts in supply chain dynamics. I'm sure I don't have to tell you that COVID-19 has created severe disruptions across multiple links in global supply chains. If you look at the chart here, we've laid this out across suppliers, producers, factories, international transport, local distribution, local transportation, at the client level. Companies are coping with numerous supply chain disruptions, which are hitting at different times in different places. And regrettably, it doesn't look like this dynamic is likely to shift in the near future for all the reasons that we've already described. The fact that there are going to be secondary outbreaks, and the fact that those secondary outbreaks are going to take place in different places at different times and will be responded to in different ways via government policymaking. So looking to the future, companies are going to be in a very dynamic situation. It's difficult to say how this is going to look, but one thing that we can say is that supply chain bottlenecks are going to take some time to ease. If you look at the chart, the heat map on the slide in front of you, what you'll see is that is manufacturing PMI laid out across the world. So manufacturing PMI basically, or Purchasing Managers Index, basically measures whether a country's manufacturing base or production base is in a state of expansion or in a state of contraction. Any country whose index is below 50 is in a state of contraction. Any that's above 50 is in a state of expansion. We've basically colored any country at or above 50 with a green shade, and anybody or any country that is below 50 with a red shade. And what you'll notice is that this map has a lot of red on it, a lot of red. Most countries are still in production contraction mode. As long as countries remain in production contraction mode and secondary outbreaks continue, companies will have to cope with bottlenecks. Now, we don't want to be all doom and gloom about this. In the same way that new rounds of outbreaks are likely to look different than the first round, supply chain bottlenecks may not remain as severe as they are now. So once again, we'd like to ask for your opinion. Looking to the future, when do you expect supply chain bottlenecks to ease substantially? All right, survey results are in and the answers range substantially, but it does seem as though the end of this year into the beginning of next year is the most popular result. This is interesting to see. It's actually quite similar to, well, somewhat similar to what we heard during the recent virtual executive roundtable that we held with around 25 senior executives from across companies. They also, the majority of them said second half of this year, first half of next year. Although they were maybe a little bit more bullish and a little bit more bearish, and that we had more people orienting towards Q3 of this year and more people orienting towards Q1 of next year. This is just indicative of the fact that there is substantial disagreement on what this looks like, a substantial uncertainty about when and how supply chains will adjust to the circumstances. But it does seem as though this will be with us for a little while longer and is likely to bleed into the first quarter of next year. Now, hopefully, these bottlenecks will loosen sooner than you all have responded, or you all seem to expect. Because they're certainly creating substantial challenges for companies. Going back to our presentation, for many companies, just a moment. There we go. For many companies, COVID-19 has raised serious questions about the resilience and flexibility of global supply chains. In particular, the coronavirus has brought to light, we would argue, 7 distinct global supply chain vulnerabilities. We're actually, side note, writing a piece of research specifically focused on this topic. So you can expect to see that in the not too distant future. It'll be a global piece focused on this item. That's where I got the framework. But let's talk through these vulnerabilities, as it's important to understand what they are. The first is too concentrated, reliance on single critical actors, whether it be one supplier for critical raw materials, one distributor to cater to all local retailers. That's created serious challenges for companies in the wake of the COVID crisis. Another vulnerability, supply chains that are too long, dependent on too many actors, or actors that are too geographically dispersed. When you're measuring the length of your supply chain in months and there are multiple disruptions, you're going to have problems. A third vulnerability, too lean. If your inventories are minimized across the entirety of your supply chain and you have absolutely no surge capacity, you've left yourself in a pretty difficult position. Admittedly, highly efficient structure, but as soon as you start hitting bumps in the road, you're gonna end up with serious issues. Too leveraged. If your cash positions are too low, or if you're too dependent on payments from other actors in the chain, extended payment terms and heightened defaults can really cause you issues. Too opaque. If you don't have enough information about what's going on across your supply chains, it's really hard to adjust. In particular, this has come to home to roost for a lot of companies who didn't know who their suppliers were. Too human dependent. If key activities like loading trucks, et cetera, need to be performed by humans for the supply chain to function, you can end up running into problems, particularly if people are facing substantial challenges. And finally, too exposed to government measures. I mean, this one, I think we've all become very well acquainted with. If your economics depend on the continuation of existing tariffs or tariff levels, production market access incentives, and free flow of goods, you're probably going to have problems. Now, of course, there are a lot of vulnerabilities here, but companies cannot address all of them at once. So with this in mind, we asked the senior executives who attended that recent virtual executive roundtable that I mentioned, that's actually last week, which of these vulnerabilities they believed was most important to address. And this is what they told us. I'll give you a moment to soak it in, but it shouldn't take too long. The responses were pretty clear. The responses suggest that supply chain's length, concentration, and exposure to government measures are really the most important vulnerabilities that multinationals need to address right now. It's difficult to draw broad conclusions here because vulnerabilities exist in a variety of different markets across Asia and the world. However, the one place where they have become particularly acute for many companies is China. And that's because these vulnerabilities have been revealed and in many cases exacerbated by heightened tensions between Washington and Beijing. You can see this dynamic in a recent poll that was taken by AmCham South China. I want to note this is AmCham down around the Guangzhou, Shenzhen, Hong Kong area, not AmCham China, which is up around Shanghai. So the point of focus tends to be a little bit different, but it is revealing nevertheless. Earlier this year, AmCham South China asked their members how the U.S.-China trade dispute has influenced their business strategy. And you can see that the responses were broken up across China-based companies, US-based companies, and companies not based in the US or in China. The survey or the sample is basically broken up almost evenly across those groups. You'll note that a large portion of companies, particularly US-based companies, were specifically looking at reducing imports and exports running between the US and China. More than 60% of respondents were looking at that as a potential option. Basically, by March of this year, a substantial portion of companies in China's southeast were evaluating opportunities to cut links in their supply chains running across the Pacific between the US and China. In looking to the future, it's reasonable to expect companies, particularly US-based companies, to continue looking for these opportunities because there's little reason to believe that US-China tensions will ease in the near future. The bottom line here is that supply chains are likely to remain in a state of flux for the foreseeable future as companies try to navigate a very dynamic situation marked by political tensions, substantial bottlenecks, and COVID-driven disruptions. So looking at the time, looks like I spoke very, very quickly on this webinar, and as a result, we have plenty of time for Q&A. So with that, I'd like to go ahead and pass things back to Raveen.
Outstanding insights. Thank you, Adam. We would now like to begin the Q&A portion of the webinar. If you have any questions, please share them with us via the GoToMeeting messenger by sending your questions to DuckerFrontier webinars. It looks like we've been receiving a flurry of questions, and we're going to take a couple of seconds to collate them, and we can have Adam address some of these. In fact, maybe we can get started with the first question. So, Adam, here he goes. We've been hearing quite a bit about this as well. And in fact, there's been quite a bit of talk about companies reducing their exposure to China, as we can see from the chart earlier as well. But we haven't seen that much in action. What are you seeing right now?
Yeah, that's a good question. So, as noted in the poll at the end, there are companies that are quite actively looking at cutting supply chain linkages between the US and China. And there are some that are looking at divesting, but by and large, we have not spoken with that many companies that are really looking actively at divesting from China. The market is simply too large, and if you look at recovery rates and which countries are or which markets are likely to recover most quickly, China remains a remarkably attractive market to be operating in, particularly right now. So when we hear companies talk about reducing their exposure to China, it hasn't been so much about reducing their presence as it has been about reducing their exposure to the sort of supply chain dynamics that I mentioned before. Looking basically at ways to diversify their production exposure. So in many ways, I would say that we're seeing an acceleration of trends now that we saw previously, right? The U.S.-China trade tensions kickstarted a lot of companies' re-examination of their supply chain structures. And this has only accelerated that. Companies that were looking to move out of South China due to rising labor costs, companies whose rationale for their existing supply chain structures relied heavily on a given set of tariffs or an established tariff structure, had already started making the move. This has just exacerbated that, or added urgency, I should say, to that dynamic. And so there have been some winners from this. Vietnam is a big one. We've seen a huge amount of money flow into Vietnam from China. And that's set to continue. We haven't necessarily seen companies take action on it, but anecdotally speaking, we have heard about several companies who are in active negotiations with Vietnamese authorities over the incentives that they can derive from a deal or use to justify a deal. There has been some noise about moving to India, about moving to other Southeast Asian markets. The rationale for doing that varies substantially, although I'd say the rationale for moving to India for any reason other than serving the domestic market is actively deteriorating. So although we haven't necessarily seen a lot of movement away from China that is markedly different than what we've seen in the past, we have seen companies begin making the moves necessary to reduce their exposure in terms of their supply chains. And actually, if I may, I just want to highlight this. Basically, what countries are trying to do is address concentration risk and risk associated with concentration, with supply chains being too long and supply chains being too exposed to government measures. That's what it comes down to. They're trying to shorten their supply chains to be closer to local demand. And if I were to bring this all together, what I'd say is, in many cases, they're also looking at ways to make sure that their supply chains allow them to keep on serving the United States as well as China looking to the future. So are companies talking about reducing their exposure to China? Yes, in so much as they have supply chain vulnerabilities. But are they looking to pull out of China or reduce their ability to serve the Chinese market? No, they're not.
Thanks, Adam. That was indeed very, very insightful. And in fact, we've been receiving a lot of questions on the topic of supply chain issues. And you can definitely see that's definitely one of those top of mind topics for a lot of our executives on the line. And in fact, we've got one question where we spoke about supply chain vulnerabilities. In fact, we're on that slide right now. We've got a question around certain recommendations that we could suggest, especially to alleviate some of these supply chain issues or vulnerabilities that multinationals are facing right now.
Yeah, that's a good question. So first and foremost, I think companies are going to really need to focus on understanding the balance that they want to strike between efficiency and robustness. Supply chains for decades were built on the basis of efficiency, kind of like a Ferrari, right? You want it to be as fast and efficient as possible. But the problem is, as soon as you take that Ferrari off-road, as soon as there are any bumps in the road or major potholes, that Ferrari is not, the machine is not going to survive very well. And so companies need to have a very open and frank conversation about where to draw the line, because it's clear that supply chains need to be more robust now than they have been in the past in order to help companies manage through the current uncertainty and the random disruptions that are going to continue to plague them over the course of the rest of this year and likely into the beginning of next year. If internally you're not aligned on that trade-off, then the time to get alignment is now. With that said, I think it's important to note that right now cash is king. Let's be frank about it. Cash is king, and so companies are not going to be able to move completely away from efficiency. That would be nuts. So it's going to be a tough conversation for a lot of companies to have, but Asia Pacific executives need to be involved in the conversation because it's going to substantially impact your ability to do business and serve customers. One aspect of this that actually did come up during the conversations that we had with executives prior to the virtual executive roundtable last week was that, for what it's worth, there are a lot of companies that are really actively looking at their logistics partners as well as their suppliers. In a time when we could all just focus on minimizing cost and maximizing efficiency instead of looking at robustness, there's much greater opportunity to put pressure on suppliers and logistics partners by finding fringe suppliers and fringe partners who were perhaps a little bit less reliable, but also much cheaper. And in using them, you could really drive down prices consistently over time, which is a great way to build efficiency into your supply chains. Yeah, every now and then things didn't go so well, but in aggregate over time, it really worked to many companies' advantages and helped to bolster their bottom lines. That time seems to be for many companies behind them. There's not so little demand. There's the demand that is out there is so precious now that many multinationals are doing whatever they have to serve those customers better. And so one thing that we have heard about is perhaps not a flight to quality, but an increased focus on the reliability of your partners and your supply chain providers. This is basically another way of saying that a lot of companies now are looking at the robustness of their supply chains and weighting that more heavily than they have in the past, right? We're hearing about this both from the provider side as well as the customer side. And so that is an area where, once again, as a customer, you need to have an honest and open conversation internally to get alignment. As a provider, if you're a company that believes that you can bring to the table a really effective value proposition on that front, now would probably be a good time to highlight that value proposition.
Great point, Adam. In fact, I think that's something that we've been hearing quite a lot in terms of using your supply chain resilience as a sort of competitive advantage as well during this time. And I think that's a good segue into another question that maybe one final question that you could address this morning for our executives on the line around how the impact of the coronavirus will have implications for competitive dynamics in the region.
Yeah, so obviously there's going to be a huge amount of variation across markets, across industries, given the fact that competitive dynamics do vary. But but with that being said, there is one thing that we have heard from different companies that is worth noting. And that's tied actually back to the second section of this webinar, which has to do with digital engagement. There's this impression that is quite prominent among individuals who really enjoy digital engagement themselves or like the cost savings associated with it, that digital will provide a great way to maintain relationships along the lines of the way that we used to see companies maintain, or the digital provides just as good of a way to maintain relationships as in-person visits do. And that is a questionable assertion. In-person visits really do help in many cases to not just build trust and develop relationships, but also, frankly speaking, to drive business. As one of our executives put it, it's amazing how much volumes tick up after a personal visit. And so if you look to next year, given what we've discussed with regards to travel restrictions, given what we've discussed with regards to executives' ability to actually engage digitally, if at all, there are going to be countries where your inability to visit in person is going to impact customers' relationships with you and their willingness to move substantial volumes with you. On the ground, on the other hand, in many cases, not much will have changed. So take China, for example, right? In China, there's no question that local competitors are still visiting their customers, and China's back to business, right? If you're not able to go visit your local customers in China and your Chinese competitors are, it is going to put you at a substantial disadvantage. And China's not the only place where we'll see that. We'll see that in plenty of other countries as well, but China's the one where we've heard the most about this. This dynamic, the travel restrictions and the reliance on digital in order to offset a sustained decrease in business travel, which you all said would drop to around 50% of last year's levels. That is going to have serious implications for your ability to compete in the market relative to local companies. And so as you think through your strategy for the rest of this year, and particularly for next year, as you look at the competitive landscape, as you think about where and how you're going to make the case for those limited but precious dollars for business travel, this should be a consideration.
Thanks, Adam. That was definitely very, very interesting to hear your perspective on that. And in fact, we've been having quite a number of questions on some of the ASEAN markets as well. And I know we spoke very briefly about them. So maybe it'd be nice to pose this question to you. So we had a question around which country in the ASEAN portfolio do you think will come out from COVID strongest, and why do you think so?
Ooh, that's a difficult question to answer. I guess it depends on the lens through which you examine the situation. So I'd say the country that will unequivocally, barring some sort of massive change, come out strongest overall is Vietnam. Vietnam was already benefiting substantially from a move away from China and other higher cost markets as it developed a substantial industrial base. I mean, we've seen that in its investment numbers and its export numbers. Its growth has been remarkable. And that's been matched in this particular situation by a government that was willing to move very aggressively very early to bring the coronavirus situation under control. I mean, okay, the numbers that they publish are a little bit questionable, right? As are most countries. I don't want to gloss over that, but they also were willing to have their legislative sessions in person, which speaks to the confidence of government officials in their efforts. So Vietnam has really done a good job of managing the outbreak thus far. And so here you have a country that was already benefiting from major secular trends in the marketplace and has now come out as one of the few Southeast Asian markets that's actually managed to bring the epidemic under control quickly. Vietnam is a clear winner in this situation. This situation is just going to accelerate the secular trends that were already taking place. And that's why, actually, let me see if I can flip back to this quickly. That's why if we look at growth across the year, you'll note that there's only one country of the 10 that are listed here that never drops into contractionary territory, and that's Vietnam.
Fantastic. Thanks, Adam. And I do recognize that we're coming to the top of the hour, and we've been receiving a lot of questions, and we'll be sure to kind of answer them and address them separately offline if we don't get the chance to address them today. And we'll be sure to follow up with these responses through your relationship manager. So before we conclude, Adam, just wanted to check with you if you've got any sort of final remarks to kind of wrap up the session and highlight any takeaways for the executives on the line.
Sure, thanks, Raveen. I'd like to finish this webinar by highlighting several key takeaways that we outlined throughout this session. First and foremost, COVID-19 is going to continue creating disruptions over the course of the rest of this year and next year. It's something that you should plan for. Don't buy into the headlines about vaccines coming into play and saving us all by the end of this year. Even if they do develop a vaccine, it's going to take a long time to produce and distribute it globally. So plan for this. But with that being said, don't expect the rest of this year and next year to look like like the situation over the course of the last 6 months. It's going to look different in all the ways that we described. That's because some countries are going to manage secondary outbreaks more effectively than others. Some countries are going to exhibit those dancing skills that we described and do a really great job relative to others in managing the ups and downs. In contrast, some countries are going to sit it out, and this is going to impact their economic prospects as well as their openness to business travel. And your ability to go actually see customers, meet with partners, see your teams. Executives are going to have to cope with continued dynamic limitations on travel that are going to impact a variety of aspects of their jobs. Right? We mentioned commercial activities, we mentioned portfolio management. Executives are going to have to think about these aspects of their jobs and so many others differently over the course of the next 12 to 18 months than they did over the course of the last several years. It's going to require a mindset shift. And finally, companies are going to need to cope with continued supply chain disruptions. And these disruptions are going to hit at different times in different places, and they're not going to be predictable. So if you have not yet identified the greatest vulnerabilities in your supply chains, if you have not yet had a conversation internally to evaluate where you want to strike the balance between efficiency and robustness, and begun to move to address those vulnerabilities. Now is the time to do it.
Thank you for rounding out the session, Adam. And that concludes our webinar for today. Thank you everyone on the line for joining us. We look forward to speaking with you again soon. Wishing you all a great